What's good, YouTube? It's your boy Sam, and I am back with another video. We've been consistent, so make sure you continue to support, subscribe, like, share, and comment, right? Let me know what you guys want to see, and we can have a nice conversation, and I'll have a better idea of more so what you guys are interested in, okay? So today is going to be a fun topic, buying the dip. As you can see here, I wrote it down. Yes, I need you guys to engrave this in your heads that buying the dip is a good strategy to entering into a particular stock that you're interested in. Okay, with that being said, a lot of people like to panic when they're in a stock and the stock starts to plummet or the stock goes down. That may not necessarily be a bad thing. However, that is how most people, in reality, all people lose money when they're red on a trade. Because to lose money, you would have to sell it lower than what you bought it at. And that is essentially what most people do. We like to call this panic selling or emotional selling. Okay, panic selling, emotional selling, and revenge trading, these are all bad things. And we will talk more in depth about those three things later on down the journey. So make sure you subscribe so you don't miss it. Okay, so what people like to do is they like to, what I like to say, get on the bandwagon. Okay, now getting on the bandwagon is not a bad thing. It's actually a really good thing. However, when you get on the bandwagon, you want to make sure that you're in early and you're not basically coming to the party when the party is already done. Because with any investment, that can be where you get the short end of the stick. Because when it comes to trading stocks, it's not like a business to where, you know, consumers come in and owners or investors make money from potential customers. You are trading against other retail traders, okay? So when I say retail traders, your average, everyday, non-professional traders like myself, and maybe you, I don't know, you may be a professional. If you are, we would love to hear from you. So drop your expertise in the comment section and we'll tap into that, right? So when it comes to retail trading, or when you're a retail seller, I should say, you may not have that much experience. And so what people like to do is listen in on news, use indicators. Indicators are essentially AI-generated tools, AI before the AI, right? AI-generated tools, these things have been around for years, to where it helps you predict what the stock is going to do based off of how it's been reacting in the past, right? So with that, you know, a lot of people tend to get in on the action after the action has already begun, and that's not good, right? So you want to wait till it starts a little bit so you get confirmation that it's doing what you think it's going to do. But what I'm basically trying to say is, if a stock so happens to be up 10% in a day and typically is up 2% or down 2% on average, and you get in after the 10%, it's already too late, okay? It's already too late, at least for short term, for the day, for the week, right? Because most of that rise has happened in a day. And so what's going to want to happen is, what the stock is going to want to do is it's going to want to pull back. And when it pulls back, to breathe so that it can get more leverage, right? That would be a good entry point for a longer term position. However, if you're just day trading or you're swing trading, it's too late, okay? So I know that was a lot, right? But now that you understand the fundamental of it, we're going to go back to the beginning, buying the dip, okay? So that was a gem for you guys. If you guys are essentially really down in a position, you don't want to panic sell, right? You want to buy low and sell high. We know this. A lot of us know this, but you must not panic when you buy in and it continues to go down. Okay, you want to buy that dip. Think of the stock like a house, right? It might be a little extreme unless you're trading this much capital, but you know, a lot of us are familiar, you know, with real estate, or more so familiar with real estate, and as opposed to stock trading, right? We all have some basic fundamental knowledge of it, right? Buying property, letting it gain equity, and selling it in the near future. So think of that when you think about stocks. You buy the stock, instead of saying 300,000, right? So we're going to use the house example. You buy a house for $300,000. 2 years from now, it may be worth 400,000, depending on, the economy or how other houses in the area are doing, or the neighborhood, news, things of that nature. Stocks are pretty similar. So if you have a stock and it's $300, or you're buying at $300, if that stock dips to, let's say, $250, you don't just sell it. You don't just sell it. You're taking a loss. You are temporarily down in that position, and you have to make sure you beat those other retail traders and you hang on. You hang on, especially if the forecast for that stock, you see it in an upward trajectory. This is a pretty stable company that you're looking at. You want to hang on to it, and when you're above what they like to say the cost basis, or I like to say your cost average, which is the price, or the average price of which you got your shares at. In the case of, if you got one share, the price you got that one share at, you want to sell it above your cost average to make profit. So if you purchased it at $300 a share, you don't want to sell it anything less than $300 a share. You want to sell it maybe at $301, right? If you want bigger returns, a dollar return on a $300 investment is really not that big of a return. But let's just say, a nice 10% gain, which would be what? 10% of 300 would be $30. So a nice 10% gain, $330, that might be a good exit point. But if the stock dips to $250, you don't just give up and panic and think that it's going to hit $100. And I'll tell you what you do if it does do that. Okay, we'll get to that in a second. But back to the house analogy, so you guys can fundamentally understand what I'm saying. If you purchase a house for $300,000 and it dips to $250,000 because some news is going on or a virus is going on, right? I know you guys remember COVID-19. That was a terrible time. However, if you purchased the house or purchased some stock around that time, when the markets were really low, when it comes to the housing market as well as the stock market, you probably came up, especially if you still have those assets here in 2026. Yeah, I know. And if you were unable to have made that investment, you can look back at the charts and see that there was a dip there to where that would have been a perfect time to buy. So we're going to apply the same thing. We can't see the future, but this is not emotion. This is logic. This is patterns. This is calculations. Okay? So with that being said, when I say buy the dip, if you're just getting into a stock, you don't just get into a stock, first of all. You want to make sure you analyze the stock. You follow the stock every day. If you're a news person, I'm not really a news person, you want to watch the news. If you're a pattern person, you want to look for patterns. And when that stock is lower than what it usually is at, and you potentially see it coming back up, that is when you put in some shares and you buy the dip, the discounted price. Same thing when it comes to property buying, right? If houses are usually $400,000, depending where you are, obviously, but if a house is $400,000 and COVID-19 happens or some crazy pandemic happens and the stock market crashes or the housing market crashes, and now that $400,000 house is $300,000, then that's when you decide to purchase that house. The same thing with the stocks, okay? So that's what I mean by buying the dip. Now, I mentioned before that if, let's say, if a stock is, if you're interested in trading a stock, right, and it falls below that price, that is a perfect opportunity for you to get in and ride the market back up to where it recovers. The same thing is happening right now with the war. It's a war going on. It's like World War all over again. Markets are crashing, people are panicking. That is the perfect opportunity to strategically get in, put your emotions aside, understand what the stock is doing relative to how it's normally trading. Even though if you may be thinking there's no return, this is especially good when the entire market is doing it and not necessarily just one particular stock. Because stocks will go bankrupt. Just because it comes down doesn't mean it's going to come back up. We know that. However, there is a higher probability that the market overall itself is going to go up. And so that is why you want to use that as an opportunity while everyone's panicking, while everyone's withdrawing their money, securing their funds, and getting out of the market. That is the perfect opportunity to go in and buy it at a discounted price. Same with the housing, right? Housing market isn't low right now, but if it was low, if there was another pandemic, a lot of people may not want to sell their homes, but if you can find some property that's on the market for lower than what it normally is, that is your chance to get in. Now, I mentioned earlier on in the video, right? What happens if it continues to go down? We call this cost averaging, and later on, we will discuss what cost averaging is. So make sure you stay tuned, and like I said, subscribe. So when I drop that video, you know exactly what I'm talking about. All right, so we're gonna keep this short. We're gonna wrap it up here soon, okay? But if a stock continues to go down after you have already bought the dip, essentially what you wanna do is buy more, bring that cost average down, and essentially when it goes back up, even just a little bit or recovers, it's a shorter way up to the cost average, and now you're in the green a lot sooner, right? So thanks for listening in, thanks for tuning in. I plan on dropping another banger here soon. So make sure you like, comment, subscribe, and share this video. Thank you very much.